Welcome to Q2's Know Your Numbers webinar. It's great having you here with us today, as this is such an important topic and something that business owners really do need to understand. For those of you who have not met me before, my name is Anne Cooper-Smith. I'm the Director and CEO of Q2 Limited and today's presenter. Q2 Limited, we're a firm of boutique business strategists and chartered accountants, and we're passionate about helping SME business owners achieve their business and their financial goals. Our brand Q2 refers to Stephen Covey's Quadrant 2, the doing what's important but not necessarily urgent quadrant. Check it out on our website if you're not familiar with what Q2 means or the Q2 story. At Q2, we have a diverse range of clients, which makes each day really interesting and different. Our clients include one-man bands through to larger SMEs employing 20 or more people. And we have startup businesses as well as some businesses that have been established for 50 years or more. And we have very profitable businesses as clients, as well as those who are not quite there yet, but they're working hard to become more profitable. The thing that all our clients have in common is a drive to improve and the need to understand their numbers to make good business decisions. Our services are as diverse as our client mix, and we help our clients in a range of different ways. But having said that, our most successful clients work with us closely on things such as business planning, problem solving, cash flow improvement, tax planning, business structures, and of course, we provide annual accounts and tax services to nearly all our clients. Before I get started, I just wanted to mention that we do have some capacity to take on new clients, and we would welcome the opportunity to have a conversation about how we may be able to assist either you or someone you know who needs expert advice at this challenging and uncertain time to make good business and investment decisions. So please get in touch if you'd like to have a discussion around how we may be able to help. So I've been working with SMEs nearly all my business life, and I know for a fact that many businesses only prepare a budget when they need to borrow money or they're worried about the cash flow. Does that sound familiar to you? However, a budget should be an integral part of the business plan, and it should also be an annual process. As Jack Lew, who was the 76th United States Secretary of Treasury, says, the budget is not just a collection of numbers, but an expression of our values and aspirations. Wow, that phrase that a budget is an expression of our values and aspirations is pretty lofty stuff. But when you think about it, it is actually really true. A budget and cash flow forecast is best practice, and it's something we should do at least annually. So hopefully you've all updated your budgets and forecasts to reflect the challenges of your particular COVID-19 situation. These numbers will express your aspirations for the business over the coming 12 months. And once you have set your budget, the next step is putting it into your accounting software. And then it's time to make sure that you can understand, monitor, and measure what you've set in those budgets and forecasts. Many business owners miss this important step, which means that the budget and forecasting process is not related to the reality of your situation. That's a really big wasted opportunity. So this webinar is about empowering business owners by demystifying the most common reports that you should be seeing on a weekly, monthly, quarterly, and annual basis, so that you're in control of your business performance, so you can compare your aspirations with reality, and that you can take appropriate steps when there's a gap. This is really important stuff, so congratulations on taking the time to attend today. Over the next 50 minutes, we'll cover the importance of really knowing and understanding your numbers. We'll cover briefly the different reports that you should be producing, and we'll explain the critical difference between profit and cash. We'll identify the key drivers of business value and highlight some ideas as to how you may be able to protect your assets, as well as how to adopt best practice. We'll then outline some potential next steps for you to take to make sure that you truly do understand your numbers. Please make sure you take plenty of notes. Some of what we talk about today may sound like a foreign language to you, and I realise we do use jargon or what we call accountanaise. So please send through your questions for us to answer afterwards if you're unsure about anything. Your business may be the most valuable asset you will ever own. So take it seriously and make good decisions, which means you absolutely must understand your numbers. So knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals you set in your business plan or business recovery plan. Here's my top 6 reasons why you need to know your numbers. First of all, they tell the story of your business, allowing you to interpret the results of your business activity. And then secondly, this helps you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, which could include perhaps ineffective pricing, rework, poor purchasing, or wastage. Thirdly, knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. And then fourthly, areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Fifthly, understanding your numbers also means that you have reliable information to base your business decisions on. And then finally, knowledge is power. The more you know about your business, the better your business will be. When I meet with a business owner, they will generally talk at length about their business, and that's understandable as they're generally really passionate about their business. This is all great background information, but until I actually see their numbers, I cannot really get their situation clear in my head. For me, an accurate profit and loss report, together with a balance sheet, will usually paint a truer picture of their business than hours spent just talking about it. So how cool is that? Those reports are just so important. Today we'll be covering each of the key reports that will help you understand what you can learn from them. And the key reports we're going to be covering today are the trading account, the profit and loss account, the balance sheet, the statement of changes in equity, the depreciation schedule, and shareholder current accounts. Now that's a real favourite aspect, and it's one that many businesses really struggle with to understand. So it's pretty important. These are just the key reports that you will get in your annual financial statements. And we're also going to work through an example to show what key learnings and things to look out for when you're looking at your reports. During this webinar, we're going to use a fictitious company called Fusco for the examples as we work through things. So keep tuned because this is going to be really interesting. The first key report is your trading account, which tracks your sales, variable costs, and gross profit to calculate the return that you're achieving before deducting your fixed overhead costs and expenses. Most people understand the importance of sales, but although getting more sales usually makes your business more successful, that is not always the case. I recall that I had a business client many years ago that finally figured out that for every new customer they signed on, the cash position and working capital declined. And that wasn't because the new sales were unprofitable, but because their business model was severely flawed. I recall that once they realized that, they sold their business pretty soon thereafter. So your gross profit percentage, which is really important you can compare it to the previous periods, and it indicates whether your margins are improving or deteriorating. Don't you agree that that's pretty important stuff to know? And you can track key results across different divisions or product lines by using multiple trading accounts. So for example, if you have different regional locations, you can have a trading account for each location, which will allow you to track how each one is performing. And interestingly enough, small adjustments to the items in your trading account can have a huge impact on your overall results, which I'll demonstrate now. So this is an example of a food manufacturing company's trading account. And as you can see, they had sales of just over 1 mil and cost of sales of $318,000. And that gave them a trading surplus of just under $700,000. Now their direct costs were just over $450,000. So their gross surplus was $248,000, giving them a gross profit percentage of 24%. The 24% is a key number, and it's calculated as the gross surplus as a percentage of sales. Now, let's say that this company undertakes coaching with their accountant and implements some strategies to increase their customer retention rate by 10%, which results in a 10% increase in sales. So let's say they also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. And then they renegotiate the contract with their delivery provider, resulting in 5% saving on the direct costs. So you can see as a result of these changes, their gross profit or surplus has increased by $140,000, and their gross profit percentage has increased from 24% to 35%. So understanding your trading account allows you to identify areas where small improvements can have a really big impact on the profitability of your business. This is really important, so write that down. In fact, the most significant changes in your business finances often arise from the trading account, and particularly from the gross profit percentage. The GP percentage tells you how efficient you are, or perhaps aren't. And generally speaking, the numbers just don't lie. And sometimes the trading account is shown on the same page as the profit and loss report, which we're going to cover next. So your profit and loss report is sometimes known as an income statement, and it shows all your earnings and costs over a period, and it tracks the overall performance of your business. It matches your income and expenses for the period, with adjustments made for timing differences. For example, sales that have been made, but the money hasn't yet been received. And technically speaking, this is what we call accrual accounting. That is accrual, A-C-C-R-U-A-L, not cruel as in C-R-U-E-L. Although as accountants, sometimes the difference can be lost. But anyway, accrual accounting is when we account for debtors, which is the money owed to you, and creditors, which is the money that you owe to others, up to a certain date. Usually 31st of March is the date we use for annual reporting, but best practice is to report monthly as well as annually. It sounds simple, but sometimes it's not, especially when there's stock involved, and especially when stock is coming perhaps from offshore with longer lead times and perhaps payments in advance or on delivery. But getting it wrong means sometimes you think you're doing great when actually that's not the case. And the opposite is often sometimes true. If you're getting good profits one year and then losses or not such good profits the next, and you really just can't understand why, maybe it's because your accrual accounting is mismatched and there's a timing variance between the different accounting periods which aren't right. And as I said before, getting the timing for accrual accounting right can sometimes be quite tricky. But even when your accounting is spot on, it's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement includes debtors and creditors, as well as non-cash expenses such as depreciation. You must also ensure that you have sufficient profit to cover cash costs such as loan principal payments, asset purchases and drawings, because none of those things are shown on the profit and loss statement. The profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between previous years and to compare your business performance to other similar businesses. Businesses are generally valued using a multiplier of earnings, so your profit and loss statement is a fundamental driver of the value of your business. And generally speaking, the higher your earnings, the higher your business value. So celebrate when you make a bigger profit. It's good. And even although you may generally be paying more tax when you make more profit, just remember that the extra tax you pay will always be relative proportionately to the amount of money you make. So aim to make more profit, not pay less tax. Okay, so this is an example of a profit and loss statement using the same fictitious food manufacturing company that we were looking at before. We've taken the gross surplus from the trading account and listed all the fixed expenses and overhead expenses, followed by the owner's remuneration to calculate the net surplus or loss. Now you can see that this company is currently trading at a loss of over $113,000. Now we know it's a loss because that number's in brackets. So let's say the company undertakes a review of all the expenses with their accountant, and we identify potential savings to be made in insurances and rent. They contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. That means that they've saved $597 in insurance expenses and just under $3,000 in rent. However, you'll notice that the accounting fees have gone up. Now remember, in the previous example, the company had engaged with their accountant for coaching and other services which had improved their gross surplus by over $140,000. And despite the increase in their accounting fees, the overall surplus has increased by $138,000 to a $24,000 profit due to the savings that they've made in the trading account and reduction of expenses. The next key report is the balance sheet, which is also known sometimes as a statement of financial position. This report provides a snapshot of your business's financial position as at a specific point in time. Most business owners only read the profit and loss report, but the balance sheet is arguably even more important than the profit and loss. And it's a real shame that business owners don't know how to read or interpret the balance sheet. In fact, understanding the balance sheet is a key part of our Quick Start financial intelligence coaching for business owners that I'll be talking about later on. The balance sheet really is important because it measures the net worth of your business, which is your assets minus your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix that. If your liabilities exceed your assets, you could easily go broke and end up being personally liable for some of those debts. That could mean losing everything you've worked so hard to build up over a long period of time. Just imagine the impact of going broke and the impact on you and your family. Just don't let that happen. Start by making sure you understand and can read your balance sheet. You can compare different periods of your balance sheet to determine whether the business's net position and worth is increasing or decreasing between periods. And you can use the balance sheet to track the financial strength of the business. The stronger the balance sheet, the easier it will be for your business to survive a downturn. Conversely, the weaker your balance sheet, the more likely it is that you could go broke. The balance sheet also provides the basis to calculate key ratios, such as your debtors days and inventory days, because both these key measures are related to your cash flow. So as you can see, the company that we're looking at is currently insolvent, as it has more liabilities than assets. Its working capital is also negative, as its current assets of $138,000 are less than the current liabilities of $162,000. This This means that the company cannot pay its short-term debts from the limited cash it has available, or the cash and the debtors and the stock that it has on hand. An urgent action is required to remedy this, so the business will need an injection of funds of at least $305,000, and that injection of funds may come in the form of share capital or perhaps a shareholder loan. Now, assuming that the company then can resolve those urgent solvency issues, there are other areas for improvement too. So over the long term, the company could implement strategies to reduce their debtors days and inventory days to increase their cash flow. To calculate your debtor days, you divide your debtors by sales and then multiply by 365 days. This tells you how long it takes for your customers to pay. Currently, this company's debtors days are 26, and that means that on average it takes customers 26 days to pay their bills. If they updated their terms of trade and requested payment within 7 days, they may be able to reduce their debtors days by 5 days to 21 days, and then they'd have an additional $13,944 available to the business. To calculate your inventory days, you can divide your inventories by the cost of sales and then multiply by 365. This gives you the number of how long the business holds this inventory before selling it. In other words, it shows how long your cash is tied up in stock and inventory. This company currently holds inventory for 74 days on average. Now, if we reviewed and updated the inventory processes and reduced the amount of inventory that they have on hand, this company might be able to improve their inventory days by, say, 9 days. And that would result in a cash flow boost of $7,860. So while this cash flow gain of nearly $22,000, which is a $13,000 for reduced debtors days and $8,000 for reduced inventory days, it doesn't fix the overall solvency issue, but it does demonstrate how much cash could be saved with some help from the company's accountant. Now, the next report usually sits between the profit and loss report and the balance sheet. It's a bit like the middle child that we tend not to pay enough attention to. But the statement of changes in equity shows what happens to the profits that the business earns. Now, the profits could be paid out as dividends or kept in the business as retained earnings and reinvested back into the business. The statement of changes in equity represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether the company is solvent also. Remember, if the company has more liabilities than assets, it's insolvent and funds will need to be paid back into the company. And if the company is insolvent, the statement of equity should highlight this problem. So pay attention to this report, and it's really a lot more important than most people realise. Now, in this situation, the company has accumulated losses for at least the last 3 years. We know that because the opening balance at the beginning of 2019 year is negative. And this means that the company has no retained earnings and is insolvent. There's no money to pay out to shareholders as dividends, and there's no money to reinvest into the company or to purchase new assets or to fund growth. The directors are going to have to take action now to increase the profitability of the company. The next key report is the shareholders' current account. This is perhaps the most controversial report and perhaps the least well understood by many people. It also affects the shareholders' personal finances, so it can be quite a touchy subject. The shareholders own the company's shares and are a separate legal entity from the company itself. So the shareholders' current account records all the funds introduced into the business by the different shareholders, or the funds that they've taken out of the business as drawings and that includes personal expenses that have been paid by the business. The shareholder's current account can help you monitor your personal expenditure from the business. And for businesses with more than one shareholder, it maintains a balance of the amount that each shareholder has introduced or withdrawn from the business. So straight away you will understand that this can be quite a sensitive topic when there are a number of different shareholders. The shareholder current accounts show how much the business owes to each shareholder. If the account is overdrawn, that means the shareholder has taken out more than they've put in, and now they owe the company money. To put the account back into a positive balance again, the shareholder can either repay the loan, or the company can increase its profit to pay a shareholder's salary, or a dividend can be declared but not taken out. Otherwise, we have to charge interest on the amount that's been overdrawn or pay fringe bit of tax to the IRD. If your shareholder's current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss what's the best option for you and your business. Because if left unaddressed, an overdrawn current account can skyrocket as a result of compounding interest that's charged for FBT purposes. As well as being poor business practice, an overdrawn shareholder's current account is also not efficient for tax purposes because of the FBT rules. So the company is going to end up paying more tax than it needs to if the current account becomes overdrawn. And no one wants to pay more tax than they need to, so your accountant should be keeping an eagle eye on the shareholder's current account and advising you about the implications. The shareholder's current account shows in this example that at the start of the period, the company owed its sole shareholder, Mr. Doe, over $29,000. He has introduced just over $2,000 into the company during the year and has taken out just over $9,000 from the company in drawings and life insurance payments. This means that at the end of the period, the company now owes Mr. Doe just under $22,000. The amount the company owes Mr. Doe can only be repaid if the company is solvent and has cash available to make the repayment. Because in an example company is insolvent, Mr. Doe will need to introduce more funds into the company so that it doesn't trade while it's insolvent. Without getting too technical, if the shareholder takes funds from the company while the company is insolvent, it's very likely that those funds will need to be paid back to the company. And to ensure that the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so that the company becomes profitable. So for example, we demonstrated in the trading account and profit and loss account before the examples how small changes to processes could result in an improvement of $138,000. It's not normally sustainable for shareholders to keep introducing money into the business if it's not profitable. And the final report we're going to cover today is the fixed asset register, which is also known as the depreciation schedule. And this depreciation schedule records the business's fixed assets, such as vehicles and plant and equipment, and facilitates the spread of the cost of those assets over the useful life. Now, when something is paid for that has a useful life of more than 12 months, it's usually treated as an asset rather than an expense. Therefore, the cost will be added to your balance sheet rather than deducted as an expense in your profit and loss report. That's why if, say, on 31st of March, you buy a motor vehicle for, say, $100,000, that will not reduce your taxable profit by $100,000 that tax year. I've had a few clients that misunderstood that and have got caught out over the years. The fixed asset register provides a basis for keeping track of the business's assets, and it can be a useful guide to determine when assets need to be replaced so that they can be budgeted for accordingly. And as I've already explained, If an asset has a useful life of more than 12 months, then it usually has to be added to the fixed asset register and is not usually an expense that will reduce the taxable profit immediately. Under the tax rules up until 16th of March 2020, any asset costing more than $500 had to be added to the fixed asset register. However, from the 17th of March 2020, the threshold increased to $5,000 as a short-term COVID-19 assistance measure. But that threshold will revert back to $1,000 on the 17th of March 2021. So we currently have a window of opportunity to write off assets up to the value of $5,000 if they're purchased before the 17th of March 21. The fixed asset register is useful when selling a business as it records the current book value of all fixed assets. However, the current book value is not the same as the market value, and assets are usually sold at the current market value. And if you sell an asset for more than its book value, there may be depreciation recovery, which is taxable income. And if you sell an asset for more than its original purchase price, the increase over the purchase price is usually capital gain and not taxable. But there are exceptions to that rule, so do take your advice from your chartered accountant. So let's look at a typical example. In this example, the first column of the fixed asset register lists the assets of all the fixed assets, and in the second column, it lists the cost price of the asset on the purchase date, and the cost is usually recorded as GST exclusive cost if the business is registered for GST. The next column shows the opening value of the asset at the start of the current financial year. This is the cost less the accumulated depreciation from previous periods. The next two columns show any purchases of new assets or disposal of old assets during the current period. A disposal could simply mean that an asset has reached the end of its useful life for depreciation purposes and no longer holds any accounting value. Then we have the depreciation rate and method of depreciation used. This company uses the diminishing value method, which depreciates each asset by a constant percentage each year. As a result, the depreciation on each asset reduces each year, and the depreciation rates used are normally those that are allowed by the IRD. Now, the next column shows the depreciation for the period, and that's followed by the accumulated depreciation. The accumulated depreciation is the amount that the asset has been depreciated since it was originally purchased. And finally, the closing column is what we call the closing or current book value of the asset. This is the value that will be recorded in the balance sheet. Sometimes a summarized depreciation schedule will be used in the annual accounts, and not all columns will show. So you or your accountant can customize which columns will show up in your annual financial statements. So that sums up the 6 key reports that you should be producing and reviewing regularly. They are the trading account, the profit and loss report, the balance sheet, the statement of changes in equity, the depreciation schedule or fixed asset register, and the shareholder's current account. Now, each of those reports tells a different story about your business and aids your decision making in a different way. And each report is important. If you have any questions about any of the reports, send them through and we'll answer them after the webinar. And in the meantime, we'll move on to understanding the difference between profit and cash. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. And sometimes it's the accountant that is the messenger that gets shot. Because sometimes we tell our clients that they have quite a lot of tax to pay, and the client retorts that we must have made a mistake because they don't have any cash in the bank, so how could they have tax to pay? And this is why it's essential that you understand the difference between profit and cash, and why a high profit doesn't necessarily result in more cash in your bank. A profitable business can go out of business simply because it's starved of cash. And then conversely, a business that's running at a loss can survive because it has access to funds from investors or financiers. So one example in that situation is Xero. Now that company has around 80% of the SME accounting software market in Australasia, but it traded for around the first 10 years before it actually even started to make a profit. And it was able to do that because it had access to investment funds to build the business through the early startup period. That was their growth strategy, and I could talk for another 50 minutes about how great that strategy actually was. However, the important thing to realise is that cash flow is every business's reality. And this is summed up by the saying, turnover is vanity, profit is sanity, and cash flow is reality. Now, to demonstrate the difference between profit and cash, let's consider these items. Now, the first one is GST. Now, GST affects your cash balance, but not your profit. Next up, we have loan payments, and loan payments affect your cash balance, but not your profit. However, interest on those loans, that does affect both your profit and your cash balance. Then, asset purchases. Now, when you purchase assets, that only affects your cash balance. And we have asset sales, once again, that only affects your cash balance. But having said that, the profit and loss will reflect any profit or loss made when you sold that asset. And then finally, we have depreciation. Now, depreciation only affects your profit as it's not a real cash cost. So you can see, even if your business has achieved a healthy profit, there may still not be any money in the bank after paying for GST, tax, making loan repayments, and buying new assets. That is why you need to understand all your financial reports and not just your profit and loss report. The profit and loss report often lies about your cash position. And remember I mentioned accrual accounting before? Well, this is where the word accrual often comes in. So let's go over the Business 101 cycle, which is another useful way to demonstrate the difference between profit and cash. So first, the owners need to invest money into the business, and then that money is used to purchase assets that are needed to run the business. The business may need additional funding or financing to buy all the assets they need, so they may take a loan to finance the purchases. And these assets are then used to generate a profit. And you can increase your profit by growing your sales or margins, but overhead expenses can drain your profit and result in a loss if they're not well managed. The profit then gets turned into cash. Now, drains on your cash include things such as slow collection of debtors, high inventory days, loan repayments, tax repayments, payments to your suppliers. A business can achieve cash gains, on the other hand, by collecting their debtors faster, decreasing their stock days, negotiating longer payment terms with their suppliers, and perhaps reducing their tax bills. The owners then take the cash out of the business as drawings or as personal loan repayments, and the remaining cash can then be reinvested back into the business to purchase more assets and generate more income. The aim here is to go through the cycle as quickly as possible to increase your return on investment. In fact, generally, the more quickly cash flows through your business, the better your business's health. It's the pulse of your business. So after cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business value. Remember we mentioned before that the better your business profit, the higher your business value. Well, the key drivers of your business value might be things like your monthly recurring revenue, or your revenue growth, or the revenue earned per customer, or your sales or profit. These will be different for every business, and it's related to the strategic business model for your specific business, but we can work with you to identify, modify, and improve the drivers of your business value. To enhance the value of your business, you must first develop and implement a clear plan and document your organizational structure and the roles within your business. Establishing cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes will help ensure that your business is running as efficiently as possible. With the technology that's available today and at such a minimal cost, there's really no reason not to utilize the best accounting practices and software within your own business. The payoff is usually exponential. Another key to enhancing business value is reducing the reliance the business has on the owners. This is because it will be easier for new owners to take over when the business is eventually sold, and this makes the business more desirable and more attractive. And finally, identifying and manage risks means that these can be mitigated before they become an issue, and that will enhance the value of the business as well. As we've seen through the webinar, the profitability, cash flow, and value of your business all affect you personally as a business owner. If your business isn't profitable and doesn't have much cash available, you won't be able to pay yourself to fund your desired lifestyle. And if you trade while insolvent, the company's directors can be held personally liable for the company's debt, and this can be a significant risk. There are some things you can do to protect your assets, which I'll quickly run through now. The first thing you can do is to set up your business as a company to limit your personal liability. Sole traders and partnerships usually have no limitation of liability at all. Secondly, consider who should be a director of your company. As I've already mentioned, company directors can be held liable for company debts in some circumstances, so don't make your spouse a director unless they are actively involved in the business. And also consider which assets are owned personally by the directors rather than being owned by the company, because company assets could be claimed by the creditors if things go wrong. Thirdly, think about taking security over any money that you've loaned to the company. Your lawyer can help you draft what we call security agreements. They're often called GSAs or General Security Agreements. If you have a GSA over the company assets, this means that if the company fails, your secured loan may rank higher than unsecured creditors, so that you'll be paid earlier than the unsecured creditors. Consider also alternate ownership structures for any high-value assets. So, for example, if the business owns your commercial business premises or expensive plant and machinery that you use in the business, consider moving the ownership of the premises or the plant to a trust or to a separate legal liability company. That separate company would then lease the premises or plant to the trading company. That way, the premises or plant would not be available to creditors if the trading company fails. Another thing you can do is review your terms of trade and credit policies to ensure you only provide credit to the customers who are likely to pay you. And you should also review your insurances to make sure that you have sufficient protection. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact on your business of any adverse events is as minimal as possible? You should also undertake financial planning to manage your personal wealth outside of the business. So, for example, think about your rental properties, your equity portfolio, or your managed fund portfolio. And then finally, plan for the future. Do you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation? For many business people, this will involve a family trust. And if you want to know more about these things, please let us know. Now, this isn't an exhaustive list. They're just some of the ways you can protect both your business assets and your personal assets. And we can help you identify specific ways you can protect your assets if you would like to explore this in more detail with us. So how does everything I've talked about today come together as best practice? Well, we believe that every business should use the 3 essential tools, and those 3 essential tools are an annual business plan, or in these challenging times, it may be called a business recovery plan. The second essential tool is an annual cash flow forecast. Remember, the forecast will reflect your aspirations for the business. And thirdly is ongoing reporting and accountability. The reporting function ensures that the numbers you want to achieve in your plan and forecast are being measured. And the accountability process is some form of coaching. By using an independent coach, they will hold you accountable, and this really works well. And I just want to say here that accounting software technology such as Xero, which really makes double entry accounting accessible to everyone, can be a bit of a double-edged sword. The case of you don't know what you don't know, so it pays to use an expert such as Q2 to set up your software correctly and ensure you're getting accurate numbers for your business. Once you're confident about your own accounting knowledge and processes, then you can take more ownership and control. But just remember the devil is often in detail, so do check in with your accountant regularly. And remember, knowing your numbers is just the beginning, as it allows you to understand and then improve them and ultimately achieve your goals and aspirations for your business. So where to from here in these challenging times? My aim with this webinar is to help you take what you've learned today and implement some positive change in your business. Now it's time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add value to your business. Think about the problems that you're experiencing in your business. By identifying these problems, you can then turn them into an opportunity by creating a project to fix them. And doing nothing, especially right now, should not be an option. So now you know what you should be doing as best practice in your business. And here's some of the ways that Q2 may be able to help you. If you don't currently have a business plan or business recovery plan, we can help you develop one. We can also create an updated cash flow forecast, which reflects the ongoing impact of COVID-19. And for those who need to be held accountable to complete your actions, we have a range of coaching options, depending on the frequency which suits you. We can create your management reports each month, catching up with you to review them so that we can discuss potential areas for improvement. We are also going to be running half-day training called Quick Start to Financial Intelligence. And this training is in groups of up to 10 people at a time and will be interactive to help people better understand their numbers. The half-day session is extraordinarily good value at $350 plus GST, and we strongly recommend that you take advantage of this offer as spaces are limited. And Q2 clients qualify for a discount and will only be paying $150 plus GST. We've also developed a free 20-page guide to your financial reports, which is packed with more detailed information and tips that we haven't had time to cover in full today. You can use the guide for your reference as you work on your numbers and improve your business. If you'd like a copy of the guide, tick that option on the exit survey after this webinar. And finally, we do offer a complimentary 1-hour meeting if you would like to review your financial reports or accounting systems. Now, we know it may be difficult to commit to spending money right now. All of these services include an assessment as to how you can improve your profitability and cash flow. So there will be a great return on investment from this process over time. And for the short term, we do offer payment options, so please don't let cost be a barrier. Get in touch with us and we can work together to come up with an arrangement that you can manage. And I also wanted to let you know that some of these services are funded by the Regional Business Partner Network. So you may qualify for 50% or even 100% funding. Contact us and we'll take you through the funding application process. We know that the benefits you'll get from all these services will be far greater than our fee. And most importantly, it's about helping you as quickly as possible and ensuring we reckon with you to build a stronger and more resilient business. This information in this webinar is general in nature and it's no substitute for specific tailored advice and support. By working with you one-on-one, we'll be able to identify the most important actions for you to take, and it will be those that have the biggest impact on your results. So thanks for making the time to attend this webinar today. We appreciate that your time is really valuable. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. And just a heads up that next month we'll be running a webinar on demystifying family trust, and it will be held on Wednesday, 21st of October at 2 p.m. So mark your diary now for this important webinar where we'll explain exactly what family trusts are, how they work, the advantages and perhaps disadvantages of family trusts, and what you need to do before 30th of January 2021 when the new Trust Act comes into play. So thanks again for making the time to listen in, and hopefully we'll see you all on Wednesday, 21st of October at 2 p.m. for our very next webinar. Thanks everybody, have a great day.